Welcome back. This is episode 4 of Crypto Options from Zero. Last time in the Vega section, I said one sentence and promised I'd come back to it properly. I said the market is constantly pricing how wild it expects the near future to be, that this pricing has a name, implied volatility, and that it isn't history, it's a forecast. Today I'm settling that debt. You'll learn where that forecast comes from, why it's almost always too high, and how to tell whether options are expensive or cheap right now. Let's start at the bottom. What is volatility actually? Volatility measures how much and how often the price of something moves. It's quoted as a percentage on an annual scale. 3 examples so you get a feel for the range. A steady utility stock, around 15% a year. The price walks, it doesn't run. Bitcoin, typically 50 to 80%. A single day on BTC can deliver as much movement as 6 months on that utility stock. A small altcoin in a bull run, 150% and up. Anything can happen there. And here's the sentence that matters most in this section. An option is, at its core, a bet on movement. So if the market prices a big move, options are expensive. If it prices a small one, they're cheap. Volatility isn't a detail attached to options. It's the thing they're built on. Now the distinction this whole episode hangs on. Volatility comes in 2 kinds, and mixing them up is the classic beginner mistake. Picture a lake. You spent a week there last summer. You open the photos from that week. You can see exactly what the water looked like each day. Monday, flat as glass. Wednesday, half-meter chop. Friday, calm again. That's data. Facts. Things that happened. Nobody argues with them. In options, this is called realized volatility, RV for short. How much the price actually moved. The past. Now the second thing. You open the forecast for next week. It says, wind 15 to 20 knots, waves 1 to 3 feet. Those aren't facts anymore. Those are expectations. And expectations have a price, because the guy renting out kayaks will charge more when the forecast calls for storms. In options, that's implied volatility. IV, how much movement the market is pricing in for what's coming, the future. Here's how to hold it. RV is the holiday photos. IV is the weather forecast. One tells you what was, the other tells you what's expected, and only that second one costs you money. And straight to Bitcoin, so this doesn't stay abstract. Over the past month, BTC moved in a way that works out to 45% volatility. That's RV, calculated from what actually happened. Meanwhile, options expiring a month from now are priced at 58%. That's IV, what the market expects. 2 numbers, 2 different worlds. And only the second one decides what you pay. So we have 2 numbers. The interesting part is comparing them. Case 1. IV is higher than RV. The market is pricing more movement than is actually happening. Options are expensive. Case 2. IV roughly equals RV. The market is pricing it fairly. Case 3. IV is below RV. The market is pricing less movement than is actually happening. Options are cheap. A real-world example. Bitcoin has been stuck in a tight range for 2 weeks. Realized volatility, 20%. But implied is sitting at 50 because there's a Fed decision in 3 days. The market hasn't lost its mind. The market knows a move is coming, and it's pricing that in ahead of time. Back to our Bitcoin numbers. Realized 45, implied 58. 13 points of difference. We're in case 1. The market is pricing more movement than is actually happening. Options are expensive, which should raise a question. Is that an exception, or is that just how it usually is? And now the most important thing in this episode. Across most markets, IV sits systematically above the volatility that actually shows up afterwards, not sometimes. Systematically on average, over years. That gap has a name. The volatility risk premium. VRP for short. The formula is trivial. IV minus RV. But why does it happen? The answer is simpler than you'd think. You put $100 on a coin flip. It's genuinely 50-50, so a fair payout would be $200. The bookmaker pays out $190. That $10 is his margin. And notice something. The bookmaker doesn't know anything about that coin that you don't. He has no secret information. He simply collects that difference systematically across thousands of bets, and the statistics work for him. The options market runs on exactly the same principle. People buying options want protection, and they're willing to overpay for peace of mind. Sellers take on that risk and collect the margin. That's why selling options carries a statistical edge. Not because sellers are smarter, but because they're sitting on the side the premium flows toward. Lock it in with numbers. The market price is 60% of volatility. A month goes by, and it turns out the real figure was 50. VRP is 10 points. That's what stayed in the seller's pocket. Before you decide you found a free lunch, 3 caveats. First, it doesn't always work. Sometimes the market underprices risk and more volatility shows up than was priced. Then the seller loses. Second, and more important, selling options has an asymmetric payoff. You win small, often, and when you lose big. One violent event can eat months of gains. Third, practical. Timing matters. There's a rule worth writing down. Sell options after the peak of fear, not during it. Because while panic is still building, IV keeps rising, and your short position keeps getting worse. It's only once the market starts calming down that the premium begins draining in your favor. So you know IV is a forecast. But where do you get a single number for all of Bitcoin? That's what DVOL is for. It's a volatility index for BTC published by the exchange Deribit, the equivalent of the VIX, if you know that one from equities. Technically, it's 30-day implied volatility, calculated from live Bitcoin options. Practically, it's a thermometer. DVOL rising, premiums get more expensive, the market is scared or expecting a move. DVOL falling, premiums get cheaper, things are settling down. In crypto, this is usually the first number you check before you even start thinking about a strategy. And now, the trap that catches a lot of people. High volatility does not mean the market is going down. Low volatility does not mean it's going up. Volatility tells you about the scale of the expected move, not the direction. Direction comes from completely different things, and those are coming in later episodes. One concrete number to close. DVOL at 45. Premiums are cheap. The market is asleep. DVOL at 85. Premiums are expensive, something is happening or about to. Same option, same strike, same expiry. At 85, you'll pay nearly twice as much for it. All right, you look at the thermometer and it reads 70. Now what? Is 70 high or low? The number on its own tells you nothing. Same as 90 degrees. That's hot for spring and cold for a sauna. You need a reference point. And for that, we go back to something you've already seen. Remember the volatility slider from last episode? The one I dragged in the Greeks Explorer, and the option's price climbed? That slider has 2 ends, a left one and a right one. That's the whole idea. Imagine the left end is the lowest volatility Bitcoin has seen over the past year, say 40%, and the right end is the highest, 100. Now there's only one question left. Where on that slider are we today? If today's volatility is 70, the handle sits exactly halfway, between 40 and 100, right in the middle. And that's IV rank, nothing more than that. It's the position of the handle on the slider, expressed from 0 to 100. Today, 50. Here's the rule you can use from tomorrow. Handle on the right, above 70. Options are expensive compared to the whole year. The natural move is selling premium. Handle on the left, below 30. Options are cheap. The natural move is buying. The middle of the slider is neutral ground. Volatility itself isn't telling you anything. It comes down to setup and direction. On some platforms, you'll see a second indicator calculated slightly differently. Instead of looking at the high and the low, it counts how many days in the year were cheaper than today. It's called IV percentile. You read it the same way. High means expensive, low means cheap. And one line worth remembering backwards. Buying options while the handle sits near the right end of the slider is guaranteed overpaying. Let's look at this on real data. Last episode, I dragged the volatility slider in the Greek's Explorer, and the options price went up. Now you know what that slider actually represents, and where its value comes from. This is implied and realized volatility for Bitcoin, plotted side by side. Notice one thing. That upper line, implied, sits above the lower one almost all the time. This isn't a one-day fluke. This is the systematic premium I've been describing. VRP, visible with your own eyes. Here, I've got the spread on its own. The difference between the two. That's today's volatility risk premium in numbers. Now watch what happens on a violent move. Implied spikes immediately because the market reacts with fear. Realized follows more slowly because all it does is measure what actually happened. And that moment where the gap is widest, that's exactly what the golden rule was pointing at. The market paid more for fear than the fear turned out to be worth. 4 things to take from this episode. 1. Realized volatility is the holiday photos, what actually happened. Implied is the forecast, what the market expects. And only the second one affects what your option costs. 2. Implied usually sits above realized. That gap is the volatility risk premium, and it's the reason selling options carries a statistical edge. 3. DVOL is the thermometer for the Bitcoin market. It rises, premiums get expensive. It falls, they get cheap. 4. The number alone means nothing. Only IV rank tells you where on the year's slider you're sitting today, and therefore whether options are expensive or cheap. And one thing above all of them, volatility tells you about the scale of a move, never the direction. Next episode, we go after the thing I deliberately kept quiet about today, because we talked about volatility as if it were a single number. In reality, it's different for every expiry, and different for every strike. That's called term structure and skew. That's where the market shows you what it's genuinely afraid of. See you in episode 5.